All right, so Steve, your first question. If you have a long call or a call spread position, when would you roll versus exiting the position? Okay, so what we're talking about here is if I just bought a call, maybe I did a bull call debit spread, Steve, if that's what you mentioned. You might be referring to a calendar spread, and that's related to Tom's question, which is second. I don't have a long call here, so let's go to other strategies and a long call position. Okay, now I'm going to go ahead. You know what I want to do? I want to go to the back test real quick for long call, if you don't mind, Steve. We're going to try to take a real world example. Let's go back a month. I'm going to go back to April 6th. And we're going to use our default Bollinger Band screen, which is based on the Bollinger Band concepts there, the settings for looking for long calls. Okay. Now, I know this takes a little bit of time. Let's apologize for that, Steve. This is because we're uploading all of the historical data right now from the end of day into the database. So when we do this back test, it takes a little bit longer. But I wanted to grab some ideas here, and this might take a little bit longer. I'm going to ignore what they are. I want to calculate the group results. So this back testing tool, during the trial, it gives you 3 months where you can go back and evaluate a certain criteria to see what trades would have matched it, and then you can calculate the group results to see how each one is performing. Some are performing well, some are not performing well. These top two, I'm going to take one. We're going to take the P interest one. Okay, so at PINS April 6th, I'm sorry, it's the August 85, and it was $11. Oh God, it's only down to $1. It's $11.63, and it's down to $1.17. That's good. That's okay though. I want to see something like that. And I'm going to take our good winner down here, a Cisco Gold Royalties, OR, and we would have bought the July 12.5 for, wow, 80 cents. Okay, great. Now, what I want to do with this, Steve, is I'm going to add it to the portfolio. I had to jot it down there on the side. We're going to put these into the portfolio. I want to go to, I had Alice's position in there today in case we had other questions on it. At least I thought I did. Yeah, I did. Great. So let's add our long calls in. We had pins. We had an August 85, if I'm not mistaken. Yes, okay. So it didn't come up. If you click on a chain, in order to make this more rapid when you're selecting positions, we just show a shortened chain. But since the fall in this stock price, what I want to click here is View All Options and go back to August. Now I've got the full chain. We got the 85 call. I know this is a loser big time, but that's what I want to address with this position. I said the 6th. Great. My original price was $11.63. Okay. Now, real quick, let's enter our other long call as well for OR. And that was the 11.5 strike, I believe, for July. 12.5, my apologies. 12.5 for July. And that was bought at 80 cents. Okay. Now we know we're getting killed on pins. What would I have done first, Steve, if I had bought this option on PINS, the August 85? I didn't see what the stock price is. I still have it up there? I'm just curious. It was at 83.29. Okay. So we're taking a huge hit here. We're down about 90% on this position. So the first thing I would have done, Steve, when I entered this position into my portfolio, is I would have clicked View under the Alert section, and I would have set an alert for the long call if it decreased 45%, and that's the danger zone. Probably 40% to have early warning. See, it's very hard to use a stop on a long call that you would use on a stock. Everyone knows Bill O'Neill, of course. If you buy a stock, you want to set a stop at 7%. Other places always recommend 10% and so forth. Okay, I can't set a 7% or 10% stop on a long call or even on a debit spread or a credit spread. Why? The reason why is because I'm probably going to hit that as soon as I open the trade just due to the bid-ask spread. And if there's any shift in volatility while I'm in a spread trade or the long call, that 7% or 10% is going to get triggered immediately. I'm going to get closed too often for small losses and not be able to see the gains. So that's the first thing I would do, is set my alert to be notified in that case. The second thing I'm going to do here is normally if I'm doing a married put, buying a call, doing a bull put credit spread, I'm looking for stocks that are trading above their 50-day or 20-day moving average. So I probably want to be notified if the stock drops below its SMA 20. If the trend reverses, Steve, I want to know. Now, I might want to be notified depending on what your game plan was for the long call or the spread. If I'm within a few days to earnings, I always avoid doing spreads around earnings unless that's your actual strategy, Steve, but you could check those as well. And you could set other alerts. We said the stock price was at 83 when we all opened this call for pins. And we could keep that same maybe 7% stop order and say, look, notify me if the stock hits $77, 6 points down, roughly 7% or so. So let's just say that there, 6 points down to 77, notify me. Now, this is hindsight, but this is what I would do. This is what I do when I enter my married puts. Those are the alerts I set, plus an additional one for my bull put credit spread, Steve. Naturally, all of our alerts are triggered in this case. So when would I have looked to get out of this position? Let's go back here, and I'm going to click on Analyze Position. I'm going to look at the stock chart in a moment, Steve, but first I'm going to look at Analyze Position. Okay, so what is this showing me? After doing the historical test, you can break down the group functions of everything that matched your criteria to see how each performed to today or to expiration. Going into the individual position, we see here that we can analyze what was our individual return on our long call versus SPX and QQQ. And of course, just down here, we have a graph of the option midpoint versus the stock price. What I'm looking at here is, remember, we initially paid $11.63 to get into the position. So a 50% loss would be when the option hit about 580. The 40% loss probably would have been triggered right here on the 19th at 650 or at 553. So we're going to write down 419. Is that? Yeah, 419. I'm sorry, folks. 419 is when that hit 650. Let's see what the actual number is. So 419 is likely my close point, Steve, for this option. Let's see. My return, minus 44%. 33% on 416. So we didn't quite hit our 40 or 45% trigger. It would have been closed on 419 for the loss of 44%. That's when I would have closed it. Why? So I'm not risking taking the 89% loss that I'm at right now in this case. Would I ever have gotten out of it? No. Up at the top, it shows us the highest return on 4.8 was 12.5% on this position. When you got into a long call, your target was probably at least a 70 or 80%. We want to use levered force. That's why you're buying the call, whether it's a leap or whether it's a straight 2-month out, 3-month out option, Steve. This wouldn't have hit your trigger to close. A lot of investors I talk to might use a 50 to 60% profit on the long call as their analysis to roll it, adjust it. We'll look at that with OR in just a moment. But in this case, this option never hit the gain that I wanted to close it or to consider rolling it. And at this point here, I would have stopped it because it hit my trigger April 19th when it was at that 40, 44, 45% loss. That avoids me taking an 89% loss. Did it recover later? Yeah, it went back up to only a 35% loss, and then it got hammered again. So with one day, after I'm saying, oh no, it's coming back. I didn't hit a 50% loss here. It's coming back. I'm only at a 35% loss. I need to do something. The very next day, you're down 75%. That's why I'm likely closing in this case back here, and I'm going to look to be more successful on the next long call or spread trade that I enter in that case. Let's go back to the portfolio. Oh, sorry, folks. I might have to relog into that in a moment. Let's go back to the portfolio, go to position, go to charts, and I'm going to go to big charts. Okay, and we're just going to look at 1 month. Let's narrow this down for us, get a better view on this. There we go. And what do I want here? The 19th. That sums it up for me perfectly. Usually, Steve, when I'm in a married put, I'm in a long call, a bull put credit spread, a bull call debit spread, even if it's out of the money bull call debit spread that's far out in time. I would be looking at, as I mentioned, for a stock trading above the 20-day moving average. I'd have looked for a positive and accelerating MACD, where the MACD is above the divergence line, usually, and it's also above the EMA 9-day. And what are my triggers? Well, when I hit the loss, that's my trigger, that minus 40, minus 45%, drops below the SMA 20, and negative MACD crossover. Would I enter a long call right now? Me personally, this doesn't have to be yours, I understand it, but the triggers that you use to enter a long call, the criteria that you use for getting into a long call, those are the ones that when they reverse, that's when you start considering that you want to get out of the position. Do you want to get around with trying to convert this now at this point to a butterfly, trying to convert it into a different position? Well, remember, the stock kept declining. So if I did a butterfly, I might have had a window here of profitability. But now that the stock's down here, I'm losing on the butterfly as well. I'm losing on my repair, and that repair might have a higher loss than that initial $11 that I put into this position. Doubt it, but it might have. Okay. Sometimes when you do a repair, you have that higher use. But what were the dates? What is the date that all of this triggered? It was the 16th and the 19th. Because that was a Friday. That was a bad close on a Friday. That's the 16th is when we dropped below the SMA 20. The RSI went negative, and we were pretty close to that 34, 35% loss. The next day, I'm out. The 19th, MACD goes negative on me, falls below the 20-day moving average. I'm at a 45% loss. I'm out. Same thing with a spread position. Whether it's a calendar spread, a bull call debit, a bull put credit, if I see that 45 to 50% loss and the triggers are hit that I use to get in the positions, again, these don't have to be yours, but whatever triggers, whatever criteria you use to get into the position, whether you use stochastics, anything along those lines, when they reverse, that's your first signal. And when you hit a loss, 40, 45% spread position, the max loss, 45% of the debit, Steve, 45% of the margin for the credit spread, 45, 50% of the cost of your long option, that tells me it's time to get out. Because sure, I could get a little bounce here, but this isn't worth it. 75, 80, 90% loss. Can't take those. Got to control the losses in these leverage positions to 50% of the max and try to look on the upside to see maximize the gains with a planned target and a trading plan, Steve, as well. Okay. Now, that being said, I will be honest with you. If you call me up on a coaching session, I've had a few of these recently. This one's a little different because it's 105 days to expiration. But a coaching session earlier this week with a customer who had a long put option, I believe it was. I can't remember the stock off the top of my head. They had their expiration was 21st of May. They're already down 92% on the position. Maybe it was during a webinar, but in any case, Steve, when I've hit that, if I've only got 14 or 15 days to expiration, I'm already down 90% of what I could lose on the position. Maybe just hold it open for the next 14 days. If it comes back up and your loss only goes to 60% or 50%, that's much better than 100%. You're already pretty much there. But in this case, with 105 days ago, I'd be looking to attempt to manage this position. But I'm going to be honest with you, looking at what we just looked at, the trading plan I use, that doesn't have to be yours, absolutely. I would have closed this on April 19th, if not the 16th. But I'm probably guaranteeing you I closed it on the 19th, 45% loss, and I'm looking to make it back up. On the upside, where are we here? OR is performing as we expected. I know it's small prices, but we paid 80 cents per contract, and it's now up to 138. So we're making $58 or 72% roughly on this position. Now I want to evaluate some of the ways that I might do this. 70 days out. Let's go to the profit and loss. Well, first, let's do what we said we'd do for Alice. Let's go to the position actions and position analysis. See if this has triggered any ideas for us for rolling out. Okay. So we could consider rolling our 1250 call up to the July 15. Why would I do this? Well, I'm going to take 58 cents of profit off the position. So I'd actually have a bulletproof long call at the 15 strike on OR. Yes, it's trading at 13.49. It's no longer in the money. But I now have no risk on this trade with the potential for further upside for the next 70 days. When you see a rollout opportunity, it's always great to evaluate, simulate the trade. Okay? So we could roll this up to the 15 strike. We're locking in $12, $13 of profit. We're taking that into our pockets right now. Still have the potential for OR to continue to go up and increase that return. Okay. However, I'm missing the other $46 of profit if I just closed it right now. This goes back to part of the trading plan. And the trading plan is, what were your goals? I'm close to maybe my 75, 80% target here. I may just close it and move on. You want to develop, Steve, for yourself, what are your target goals for the long haul portion of your portfolio? It's okay to look for 100, 150, and 200% if that's the rates you see from time to time and you're confident in your stock selection. But keep the losses to 50%. Don't let them go too far below your positions. Are there other ways that we could adjust this? Sure. I could sell, we're out to July. So I'm just going to do this manually. Sometimes it shows you could build a calendar spread. Not worth it to go to May. I don't want to do a horizontal in this case with the stock at 13.49. Let's see if we have any love in June. 20 cents. But hey, we only paid 80 cents for it, so we're getting a fourth back. I could convert it to a calendar spread for June expiration. Increases my potential profit up to 191.79 with a cost basis of 60. Okay. Let's increase this a little bit. There we go. And we're close to the 2 expirations. So that way it kind of looks like a covered call instead of one that's trailing off. What have I done here? I've reduced my exposure. I took in a small premium of $20, but hey, that's a fourth of what I paid for the position. I have a higher max return than I do right now. And that's a good percentage return. If the stock's trading right at 15 or above, I'm still in a reasonable profit. If the stock's still trading at, let me go down here, $14, $12.50 is not that great. It's only $2 profit. So yeah, it's not giving me the 13 or the 14. I apologize for that. But in any case, you can see here at $14, we'd still be at about maybe $105, $110 profit. That's almost double the 58 cents we have right now. So if you're still confident in the stock going up, there's an idea. In this case, because of the strikes that are available, I can't roll up this option as I wanted, roll up to the 15 strike and then sell the June 15 call. You could do that. That would put you in a horizontal calendar spread. I don't know if that's going to give you the value that you truly want there, but you did see that you could have a full bulletproof position already by just rolling up to the July 15 strike. Then you could maybe sell the June 15 strike against it for another $20, give you a guaranteed profit of 33. For further insight into this, of course, I remind you, you can navigate anytime over to YouTube, Steve. Last 2 weeks ago, yeah, there it is. 2 weeks ago, we covered this topic 27 minutes long, 8 ways to manage a profitable long call. So we got a little bit more in depth in converting to a butterfly, doing that calendar spread I just mentioned, rolling up the call, and then doing the calendar spread as well. For the debit spreads or credit spreads, there's ideas in here. You could just do a search for debit spread management, manage debit. Let's see if anything comes up. Evaluating ways to manage debit spread, up or down. So that's a shorter one, I thought. Yeah, 12 minutes and 5 seconds there, Steve. So that'll give you some more insight into some of the other things you can do there that we won't go into today too deeply. But again, important things here. Set your trading plan for your goals, Steve. Tracking the positions in the portfolio. Set the alerts as necessary. I mentioned I set mine based on the reversals of what I would have used to get in there. I would have used the Bollinger Bands as well. If the stock is getting near the lower Bollinger Band, for example, let's see here. Yeah, not as good as I'd want. I'd want to see it if it goes below the 20-day moving average, which I'm already using. Definitely if it broached the lower band, I'd probably get out. But Steve, again, that's too late. If it breaks below the lower band, that's probably too late. And I'm looking at that 70, 80% loss in that case. Both for credit spreads, debit spreads, long calls, long puts, 40, 45, 50% decrease should be the floor. Set that alert there. Set the alerts on the simple moving averages that you might be using, if anything else is there as well. Take a look at that and evaluate it. For the winners, two different approaches. If I'm doing a short-term weekly bull put credit spread where I'm looking to make a 15% leverage return, I try to hold it as close to expiration as possible to realize the maximum profit. I don't close my credit spreads at 50% gain because that means I'm only getting 7%. I'm not going to be hitting my targets in that case. So I'm going to be looking to take that. But some investors, do at or just out of the money debit spreads, where on our example with the stock at 83 for pins, at the same time, we might have sold a couple month out 85 call and bought an 80 to get close to a 1-to-1 risk reward ratio. And the investors that use that approach, if they hit 50% of the expected profit early, they'll close out that debit spread. I'm not saying you should do that with the long calls necessarily if you have a higher target, but that's what they might look for. But the bottom is the same. They'll close it if it hits a 50% of the max loss expected, because you want to try to control that and keep it so it doesn't go to 70, 80, or 90, because that's when your performance and your trading plan starts to move against you. Fantastic. Steve, you're welcome. I hope that was useful. And remember, go over to YouTube later if you have the time, and you can do some more of that analysis. Go through that video where we did the 8 ways to manage a long profitable call for OR. In the case of OR, those could be applied. But also there's the one there on managing your debit spreads. Bernie, and you said earlier this week, I asked what Ernie would do once the price goes above the up and Bollinger Band. Ernie says sometimes it pulls back. Now, what does Ernie do to keep the price high in the Bollinger Band? Would this work in case of OR, as you just explained? Okay, so let's go back to OR. And yeah, let's go back to our portfolio and go back to today's presentation. So I've got some gains going on, as we mentioned, in OR. Bernie, your question I might not include your question in Steve's initial discussion there, but we'll see. Okay, but we'll take a look at this because it does relate to it. I'll crop out those last 2 sections, put yours with. Okay. So what's Bernie talking about? Well, we've had our gains on this position. It's been moving up. Okay. And what Bernie is referring to, let's go back to our 1-month chart here, is that original screen that I pulled up when I did the search from a month ago on April 6th. It's just shy of it. I'm sorry, Bernie. I'm going to go back to 2 months. I'm sorry. Okay, so April 6th-ish, I think, is when I ran our default search. Right. And what we look at in those cases is the fact that that search was the Bollinger Band search. So it was looking for positions that were near the top or had closed above the upper Bollinger Band. Because usually when you have that Bollinger Band breakout, you see a slight easing, and then it starts taking off. Okay? So what Bernie's asking is, now that if I was in this OR position, which I'm not, and now it's done what I expected and it breached above it, Bernie's question is, do you keep it? Sometimes pulls back. So what would Ernie do in this case if he was in the position? I can't answer for Ernie directly, but Bernie, what I related to Steve already is that it would come down to, what is my trading plan? Remember, we're at a 71, 72% gain, 71.9% gain on this position. If my trigger is 75, I'm pretty close to hitting that in this case. Okay, I might be just closing this position and taking the profit because I've hit my goals. Yes, it's a winner. And yes, it could continue to run. Now, Ernie, I can't answer for him directly, but I know from time to time what he does do is continue to add calls to the position, what some refer to as laddering. So now that he had the pullback he expected, he didn't hit a 50% loss yet, not near it, he's still profitable, but now he sees this, he might be buying 13 calls, expecting the run to continue. And then when he sees it start leveling off, then he may manage it in that case. If his outlook is still, remember, these were July options, if I'm not mistaken. It was August for pins. I think these were July for OR. Yes, we still have 70 days. So If the pullback starts to come back, he might close and take a 50% profit. That's a possibility. If he's hit his target, if I'm hitting my target, I'm closing right now. I'm not worried about over management in this case. He might be adding to the position, in this case, expecting the stock to continue to move up after this new Bollinger Band breakout, before it starts to ease off. Because remember, when we saw the breakout here, it kept going up. It went up, and then it started its little pullback over here. But this was still probably reasonable profit of 50%. And then it pulled back. We were probably still at a reasonable profit from when we got in. Maybe we're at a loss. We're at a loss. I'm sorry. We're at a loss. But it didn't quite go into the negative realm I wanted to just yet. May have closed at that point. Bernie, I can't answer that question. Would he have sold when it came down here? Again, just what we covered for Steve. Maybe. If it hit that 40 or 55% loss. If it hadn't hit that loss percentage yet, we'd stay in it. I'd probably stay in it. Can't answer for Ernie. I don't know his 100% thoughts, Bernie. Okay. So he might have averaged down here as well. It's a possibility. Okay. It's tough to say. It's tough to say. And I'm not avoiding the question, Bernie. I just can't answer for Ernie. I don't have all of 100% of his approaches used. We differ slightly, which is of benefit to you guys because you get two different stories. Yeah, Bernie, that's the case with OR. Again, doing further analysis on the OR position. I would, that other video we mentioned there about the 8 ways to manage a long profitable call, those would be some great ways to do it in that case. All right. There's no one way to do it. Honestly, one thing that I didn't mention for Steve, and one thing that would probably be happening right now with OR, for me personally, if this was in my portfolio, I would have likely traded this. Maybe only 7, but I would have likely traded. We're just talking about one contract here, Bernie. I would have probably done 10 contracts here, maybe 7 based on my cost basis, but let me edit the position. So let's put that up to 10. And so for right now, even though my target is usually, again, 75 to 80% on a winning call to reduce exposure, one of those 8 ways we discussed in that video from the other week, I'm sorry, go to July, is to sell half. I'm going to take half of them off the board. Now, we already saw that we could roll up OR and have a no-risk position, a guaranteed $12, $13 profit. This did not do as much as I wanted it to, okay? So we're going to sell 5 for that $1.58. In this case, we're going to get $6.87 back. So I still have an exposure of 112. In this case, with still unlimited upside. Now I can roll those other 5s up potentially to the 15, and we could have no risk on that as well. So in those 8 ways, we talk about combining the different adjustments there in that case, Bernie. So the key is, for me personally, you would ask another question about what does divergence say? I don't get too bogged down in the technicals. I know it sounds like I do, but that's for my stops. When it has another breakout like this and it's doing what I want, I'm going to go back and analyze, why did this break out? Was it really positive earnings that just came out? Was there something that changed in the sector or industry? Because if that's going to promote higher growth near term, even though we had the Bollinger Band breakout and it might start coming back down soon, I'm still 70 days out. I probably have a good 6 or 7 ways to manage this existing long call to cut down the risk, potentially have no risk, Bernie, or generate income on the calendar call side, or combinations of all 3. That's the approach that I might consider looking for. But again, once I hit my targets for exit, 80% is usually it, Bernie, that's when I'm probably going to go. I can't answer directly for how Ernie would play that. I can, you schedule another coaching session with him for next week sometime. I can give him the OR example, exactly what we discussed today. I can send him some screenshots of what we discussed today, and you can ask him how he would do it. That's perfectly fine. Okay, and it's hard for him maybe to answer it because if he's not in the position, he's saying, well, I could do this or I could do that, kind of like I'm doing right now. But if you want his specifics on how he does it, hey, that's what the benefits are of being a member of Power Options. You can schedule one of those coaching sessions at any time. And if you want to talk about that with his thoughts, I'll give him the write-up, send up the screenshots for the OR position, when the purchase was, what we're looking at now. And you can ask him about it, or send us directly an email, and I'll also send Ernie those thoughts, and you can get his thoughts on how he would manage that long call position.